right, good morning, everybody. We are live. This is CertaPay's Coffee Break, and we are Coffee Break number 8 for the year, and very excited to be here with you today. Thank you for joining us. And today we're going to be talking about pay classifications and why it's so important. I am your host, Rachel Camella, and I'm here with our moderators, Cindy Merkel from our fabulous HR team over at CertaPay. So welcome, everybody. Let's get started. First things first, I am drinking a delicious Honduras Especial with notes of apple, butterscotch, and raisin. And it is delicious, so I know you're all jealous. What do you have, Cindy? Same?
Same thing. Espresso or dark roast.
I love it. I hope you guys all have a good coffee with you out there, because this topic is really important. And there's a lot of math. So just be ready, keep your mind clear, enjoy your coffee, and pop those questions in the chat box. We'll get to them. But pay classifications are really an important topic. And this conversation is absolutely critical because as a business owner, you don't want to have those big risk and exposure points open. And this is a big one because the amount of money we see in back wages is huge numbers of dollars. So it's an important thing to pay attention to, and it's an important thing to get right. 70 to 90% of the businesses out there get it wrong. So that means 70 to 90% of you on this call probably have something misclassified when we talk about these pay classifications. So we want to get this one right. Complaints are the main driving factor here. So what happens is somebody feels like they didn't get paid right, and they're going to complain. They're going to call the DOL and they're going to say, I think I'm supposed to get overtime and I'm classified as a salaried employee, or, there may be some issue there. And that's what drives the complaints. The DOL doesn't just randomly knock on your door. It's because they had a reason to. And the way it works is somebody will complain and the DOL will reply. They'll say to you, hey, we got this complaint. They said that maybe they're supposed to get time and a half. How do you reply to that? And so then you're going to write back, no. This is truly a salaried employee. Here's the job description. These are the duties. They have 2 direct reports. And the DOL might say, oh, yeah, seems like, it's just an error, or they thought something different and, we're going to move on. That actually doesn't happen all that often. Mostly what they say is, interesting. Can you tell me more about it? Tell me about this individual's job description. And you probably have them classified as a salaried employee and they're supposed to be hourly. So the DOL is like, something isn't adding up. Will you send us the timesheets? And then you're not going to have any timesheets because they're salaried. And the DOL is going to say, I think we need to recreate some timesheets here. And then they're going to say, we got a little something here. We're going to come in and take a look. And so that's kind of how that happens. When they come in for an audit, when I say recreate a timesheet, they will really do it. They're going to say, when did this person log into their computer? When did they go through the parking garage gate? When did they answer their first phone call, send their first text? And then they will create a timeline of when they started working. Or even things like, if you automatically deduct time for a lunch break, this is one of the things, like, we used to do this, a while ago, but it's really not best practice anymore because the DOL wants to see the exact time that somebody's working. So if you automatically deduct an hour or 30 minutes for lunch, and then that person says, no, I don't take a lunch, I always work through my lunch, it will be easy for them to say, they sent 2 emails, they answered the phone, they sent these text messages. It looks like they were actually working through lunch. So now you not only owe those back wages for lunch, you may owe back wages for overtime, and you're going to have fines and fees for not processing correctly. And same thing with that whole timesheet grid that they create. It's going to be all of the hours. If you paid somebody a salary and they're normally spending 45 hours a week, you're going to have those overtime dollars to pay and fines and fees for every pay cycle that's out of compliance. So again, getting this right is really, really important. We see hundreds of millions of dollars in back wages paid every year because of audits like this. And back wages are carved in stone. If you owe wages, you owe wages. Not only that, but following an audit, you have 30 days to pay it. So the DOL will get wages one way or another. Sometimes you can negotiate the fees, but wages are wages, and you better figure out how to pay those pretty quickly. So the other important piece is that risk and exposure that I talk about. It's really simple to go through and do an audit of your classifications and get it right and close those exposure gaps than it is to go back and pay the price for not having done it. It's way more expensive on the backside. So the other thing that happens after a DOL audit is the phone calls afterward. So the DOL will complete their audit, get all their back wages and fines and fees and whatnot, and then they're going to call their buddies at OSHA. They're going to say, hey, I couldn't even find any OSHA reports or files. You might check this out. Hey, IRS, there's some back taxes here that it looks like haven't been covered. They've got most of their employees classified as 1099s. You might go check it out. Or they might call Homeland Security. Hey, Homeland Security, I can't even find the I-9s. They're all over the place. You might go check that out. And it is not uncommon for us to see 2 or 3 follow-up audits from other agencies following a DOL audit. So it's not just the one piece of exposure to close, but if that one's open, the door is open to a bunch of others. All right. How are we doing? Is everybody in a panic or are you good? That's the panic slide.
That's the panic, yeah.
Okay, so just in case you haven't panicked enough, let me push you over the edge. So what we're going to talk about are the different pay classifications here. We've got exempt employees and non-exempt employees, this is what most of you guys know. Your exempt employees are your salaried employees. Your non-exempt employees are your hourly employees. I put commission sales in here because I know we have a lot of clients who do pay commissions, and so I really want to clarify how to do this in compliance and make sure we're following those guidelines to protect you all. And then finally, 1099 employees, an important thing to look at because we used to have a very broad range of qualifications for 1099, and it's really much narrower now, and it's important to put the majority of those people as employees if that's the case. So we'll cover those pieces too. And then again, I encourage you guys to ask questions. I know this is a heavy subject with a lot of details. So don't be afraid to ask your question because I am sure somebody else is wondering the same thing. So let's start with exempt. So the exempt classification is your salaried employees. So there's very specific criteria here. The first thing is you meet the minimum amount of pay. And that salary threshold right now is $35,568 or $684 a week. And that's the minimum. And so we used to just kind of go by that. In the past, we would say, well, I'm paying them over the threshold, their salary. But that's not how it is anymore. It's way more clear. And so it is the duties test that really gives us some specific information. And when we take a look at the duties test, it's really broken out into a bunch of different categories. So the first 3 are the main ones. You have executive, administrative, and professional. So you've got that main salary threshold. That's question number 1. If you do not meet that threshold, you're automatically putting the employee in a non-exempt hourly classification, and that's the end of the discussion. If they are over that, then go to the next question. Which one of these exemptions do they fit into? And chances are it's one of these first 3. So if you're in the executive, Then the next question is, do you have at least 2 direct reports? If you only have 1 direct report and none of these other things apply, done deal. But let's say you have 2. Okay, now it goes to duties. What does this person do? Is this a decision maker? Is this the authority? Is this the hiring, firing? So in this executive category, you think your directors, your executive leaders, the people who are managing departments, this is the executive exemption. And next we have the administrative exemption. So the confusion on the administrative exemption is it's not administrative assistance. It is not administrative support. It is the administrative top level of people who are operating the business. These are the people who are moving the business decisions forward. Their primary duties are in the office, and they are directly connected to the business operations. They have all independent judgment. So they are not being told by somebody else what to do. So when you think of the administrative assistants and the support people, they're following the orders of somebody else. So they do not meet this exemption. Now, let's say we have somebody who perhaps manages the office, and this person has 4 people who report to her or him, and they have the decision-making capability in their role, and they are a critical part of keeping the business moving forward. That person would fall under the executive exemption. So you have some different questions to ask, and we see this administrative exemption applied incorrectly all the time. This is not your support people. This is not somebody who happens to work in the office. That is not what it means. It has to do with the independent judgment and the decision-making connected to their duties. Are we good?
Rachel, do you want to give an idea of what that administrative job may be, like a comptroller, an accountant, etc.?
Right. So it could even be, those are 2 perfect examples. Somebody who is actually, not necessarily an accountant, but maybe somebody who is managing the entire accounting process. But maybe they only have 1 person who reports to them. That person could actually be the director of the accounting department. And, so they have the administrative duties, their independent judgment. They are responsible for moving the business forward, but maybe they just don't have 2 direct reports.
Rachel, just because it's a good question, I think and I know we have a lot of hospitality, where would you put a restaurant manager under the administrative as they have to forward the business?
So it depends. A restaurant manager, because they're over the threshold, they've got 2 direct reports, and they're managing the whole place, that would be the executive exemption. And because a restaurant, the administrative exemption is really more like an office building or a white collar scenario. Maybe the administrative exemption might work for, let's say, somebody in the corporate office of a restaurant chain who may be, have some primary decision making and independent judgment, but doesn't have 2 direct reports. But the actual restaurant managers who are doing all of the decision making for a particular location, managing all of the staff, that's the executive exemption. And it is a great question. So thank you for posing that. Because there are some gray areas here. Next we have the professional exemption. And again, this is where people just say, oh, well, I'm a professional, I put them in that. But this is typically a higher level of skill. So a much higher level, let's say in the science category or in an intellectual category where additional education and training is required. And so somebody may have had to get a special degree or special training for a particular professional category. Again, this one is going to be in an office environment or where they have independent judgment and they exercise their own discretion in decision making. So when we see these exempt duties, you really want to think about the decision makers of the organization. These are people who, they don't have to go ask somebody else if it's okay to do something. Basically, when you think about that, these are the leaders and the people driving the business forward. And so now we get into a little bit of a gray area, our outside sales. I put this in here because the outside sales exemption, the way it was originally written, kind of doesn't exist anymore because of technology and because of the way things are in 2021. The true outside sales individual completes the sale at the location of the buyer. So somebody who is working from home, who, they're outside the business office, they might be working from home, they make phone calls, they're sending emails, they're connecting with the end buyer via phone or email or whatever it is. They are actually considered inside sales, and their home-based location is considered the business. So those people are not actually outside sales. And this is, you think of somebody who is the end buyer, like the vacuum cleaner sales guy who went door to door and sold the Kirby, or somebody who sells B2B, where your sale actually takes place at the business location of the buyer. But most of our sales nowadays are not considered true outside sales. So why is this an issue? Well, under the outside sales exemption, you can pay these folks commission only. But most of these sales positions that we see currently in 2021 do not meet the qualifications for true outside sales. So that's where you want to be careful. If you have somebody classified that way, you really want to look at it. What is actually happening? We have an example of one of our clients, and they have a sales division. All of the people work from home, but they send them a list. These are the people you're going to call, and and they have them listed as commission only. And all of their sales were occurring over the phone and completed via email communication. So these are technically inside sales. So when somebody is inside sales, now what? Well, now you have to meet all of the minimum thresholds. So if somebody is an inside sales agent and you're going to pay them a commission, you need to first meet all minimum wage requirements for your state. So that person would need to be paid for every hour that they work. So now you have a situation where you have to be tracking their hours, because you can't, even if you pay them huge commission dollars, you still need to be able to prove that you've paid them above minimum wage. So hours have to be tracked. And then you pay them a base of an hourly minimum wage amount, and then the commissions on top of that. Now, because they are a non-exempt hourly individual, you have to factor in commissions to overtime. So we're going to dig into that just a little bit more in a second, but keep that in mind. If you just automatically have people classified as commission only, you want to pay close attention to that. This is a place where that would be a misclassification. You want to get that classification correct, even if it means a fluctuating hourly rate or blending the rate. We're going to talk about that some more in just a bit.
Rachel?
So yeah.
Are you going to get into also the difference when you give them a base plus commission when you get to that section?
Yeah.
Okay, just a second. Thank you.
That's where the good stuff is, and you might have to break out a calculator, but yeah, it's all good stuff. And I wanted to go back real quick. I saw a message up there about automatically deducting for an employee's lunch. This is no longer a best practice. It's really a risky thing to do. Like I said, you want to really have people clock in and clock out themselves and pay them for the exact times that they're working. And if I go back to the DOL creating a timesheet, what they're going to do is if they see automatic times, like every day from 12 to 1, everybody is at lunch, that's a red flag to the DOL. They're going to say, we know this isn't possible because just based on human nature. Somebody got back at 11:53, or somebody left at 11:53. Somebody got back at 1:07. Somebody left at 12:30. So just by the DOL looking at human nature, when there's exact times down the grid for arrival times, lunch times, departure times, those are red flags. You want to make sure that it's real time. And that's another place to, make sure you have the correct technology. There should be real time time clocks, or make sure they have a timekeeping app on their smartphone where they can clock in exactly when they begin work, clock out when they're taking their lunch, clock in when they return, and so on. That's a really important piece because it's a red flag to the DOL, and you don't want to create any red flags for the DOL. So that's a good question. I appreciate that one. So let's keep going on this, and then we're going to dig into those numbers like Cindy said. So the computer exemption, this is another place where we see quite a few misclassifications because the computer exemption is really specific. It's the programmers, it's the software engineers. It's not my employee works on a computer. Just because you work on a computer all day doesn't give you the computer exemption. It's the guy who developed the computer, and that is the person, man or woman, who's eligible for that exemption. And so there are some specifics there you want to be careful about. It doesn't just mean everybody in the office, they are working on a computer, therefore that's the exemption. No, it's very specific. It's skilled computer programmers, systems analysts, software engineers, these high-level, highly educated computer engineers who meet this qualification. And finally, the highly comp. Again, this is a threshold that has to be met. That 107,432 is the highly compensated threshold. So if you've got somebody who's making over that threshold, there's a chance they will qualify for exempt status. But they have to have one of these other pieces from the first three that we talked about. And so if they've got one of these other duties, let's say you've got a highly skilled, knowledgeable scientist, he doesn't have any direct reports, or she doesn't have any direct reports, but they make 110,000, they would be able to fall into the highly comp exemption. Or maybe this is your somebody who has one of the decision-making duties of an executive team member, and they're in that highly comp category. So the highly comp is just basically a higher threshold with the duties in one of the first three classifications. How we doing, guys? Are we good?
Keep going, Rachel.
Good. Okay. So the issues that I want to go back and dig into just a little bit. Okay, so blue collar workers are actually never exempt. So if there is any type of blue collar worker, these cannot be exempt at all, no matter if they're highly comp or not. And the list is huge, and it's the electricians, plumbers, construction workers, carpenters, mechanics, any laborers, trades folks. These are anything in this blue collar list. They are non-exempt hourly folks, no matter how much they make. And so we see some misclassification here. And you guys know who you are out there, my electricians and plumbers and, some of the carpenters and those pieces of work, because you do pay these folks a lot of money, and they get commissions and they get extra dollars. So it's important to get this pay classification correct. And here, you might do different things like paying piece rate and fluctuating hourly rates and commission dollars on top of a base and whatnot. And again, we're going to talk about this in just a second, but if you look at the actual tasks and the actual work, if somebody is an electrician or a roofer or a plumber or doing construction labor, these cannot be exempt positions under any scenario. So the next thing that is an issue that we see frequently is the job title. You know, well, we give them this director title or this manager title just because they have the manager title doesn't automatically make them an exempt salaried employee. It goes back to those duties that we talked about. That's the important piece, the duties. And this is a carryover because, you know, as recently as 5-7 years ago, we were still looking at the job title. If it said manager in the title, then they were above that threshold, which used to be 23,000, which was pretty much anybody who was a manager. That exemption would apply. And so the duties test is the important piece now because it's no longer that way. The other thing that we see frequently is, well, my employee wants me to pay them like this. My employee wants to be salaried. And, you know, that's a common thing. So you want to be very careful. This decision is not up to the employee. You are in charge of your organization. You want to be in compliance with the DOL's regulations. And you tell the employee, this is the way this position is classified. So the issue here, especially if somebody is classified currently as salaried but shouldn't be, it can be perceived as a demotion. So an area where you really want to proceed carefully and respectfully, knowing that there's an emotional component there where the employee could feel offended or demoted or somehow as if they're less important, which obviously is not the case. Our people are the most important thing in our businesses, and they are the reason that we are able to succeed in our businesses. So making sure that message is clear, if you have to make a change, that's important. And then having all of the classifications correct before somebody starts is an important piece too. And sometimes I have people say, well, we have agreements, and they sign the agreement, so they know this is how we're paying them. And again, that doesn't matter. That's actually a little bit dangerous because now you're providing some evidence that can be used as a weapon against you. So be very careful about having somebody sign something about their pay structure is okay. Make sure it's in compliance. That's the piece you want to double check on to make sure you have the correct language in anything like that. Okay, so we're going to switch to non-exempt. How we doing? Is everybody with me? So non-exempt, these are the hourly employees, and we have varying minimum wages across the country. We have our federal minimum wage that hasn't changed in a long time, and most states have a different minimum wage now. So we want to pay close attention to your state's guidelines and your state's minimum wage. You have to pay non-exempt employees for every hour that they work, no matter what. And this is an important piece after moving into COVID, when we shifted to a lot of remote work, and we still have these non-exempt hourly employees working from home. And it's important to make sure you are paying correctly for all the hours worked, regardless of where the hours fall in the timeline. If somebody gets up and starts checking emails at 6 a.m., make sure they have a method to clock in before they start work, or you have a proper tracking for their time while they're working remotely. This is an important piece. In addition, we have to pay time and a half or the proper overtime for your state's requirements. Most of the states have over 40 hours in a week as the time and a half compliance piece, but some states like California has over 8 hours in a day is time and a half, over 12 in the same day is double time, a seventh day is double time. So check with your state. You have some different requirements there for overtime, and you want to be mindful of that. So non-exempt employees need to get paid at least minimum wage for your state following the guidelines. They need to be paid for every hour worked, no matter what, and you pay the overtime properly. And it's important to have accurate tracking on here. Again, you know, I still see people who are doing handwritten timesheets and, you know, some like those everyone arrived at 8 o'clock kind of things. You want to have an accurate electronic timekeeping method that is in compliance and can really help you when called upon. If the DOL says, show me your timekeeping method, and you pull out, you know, a folder of handwritten papers, you might have some trouble there. I want to touch on this fact sheet 20 because this is a place where we see some people saying that, oh, my commission guys, we need this fact sheet 20 guidance so we can pay just commissions. But again, I want to go over what this looks like and how to caution that. So if you are a retail establishment where the majority of your dollars are coming from goods or services provided, then that's the first piece of the criteria. And then the next thing is the employee is employed at that location. So it can't be we sent somebody to go do a job who came down from our corporate office or whatever. It has to be this is an employee of that exact location, and she went to go do work and she gets paid a commission on what she sells or what she does. So if the individual meets the criteria for this type of commission earnings, then you have to pay them. The minimum threshold is different. So now you're not just minimum wage and you're not minimum salary threshold. Your minimum threshold under this commission structure is a calculation of time and a half times all of the hours worked. And so sometimes you might have, let's say, a roofer who is paid by commissions, and they earn a ton of commission dollars. So you know they're over the threshold. But the issue here is they don't know how many hours they worked because they don't track the hours. So the important thing is you have to track the hours to prove that you're above that minimum threshold. So that's the important piece. Make sure if you do have somebody who by chance in rare cases meets this criteria for commission earnings, then they you have to meet that minimum threshold and you have to track the hours to show that you did meet that threshold. And the other thing is more than half of their earnings have to actually come from the commission dollars. Now, what we see here is, let's say, technicians who sell. Let's say a plumber who also sells the job for the work that they do. There's a real issue here because even though they earn a lot of commission dollars, they're doing the technical blue collar work. So these individuals do not qualify. They would need to be qualified as a non-exempt hourly employee. And then we figure out how to factor in those commission dollars. So when we talk about commission pay for outside sales, that's, like I said, it's the people whose sale actually occurs at the end buyer's location. And they can be commission-only individuals. But let's take a look at these other pieces, fluctuating rate or piece rate, and factor in how those dollars fit with overtime. So if you have a fluctuating rate, let's say you've got that plumber who also sells. The plumber does the work and the plumber sells extra services and materials and whatnot. They get a commission for those dollars, but they might get an hourly rate for the work that they do. So you can take the base hourly pay for the hours that they work as a technician, you know, whatever it is, let's say it's $15 an hour, and then they get commissions on top of that for all those dollars they sold, but they typically work about 50 hours a week. So now in this fluctuating rate, what you need to do is take all of the dollars from the hourly work, all of the dollars from the commissions earned, and add them together. Now divide that by all of the hours worked in the week. So this is your fluctuating rate of the pay period. And then what you have to do is multiply the difference to get that time and a half number, the overtime number. So if you've paid all of your dollars are paid, so your hourly is there, your commissions, those are all of your earnings. Now you have that new effective hourly rate or the fluctuating hourly rate for the period, and you have to pay 10 more of those overtime hours because this person works 50 hours. So you have to pay 10 more of those hours at an extra 0.5 times your fluctuating rate. I know I'm getting a little crazy on the math, and if this applies to you, please reach out to us. Let us help you with this. We want you to get it right because it's a big one, and this is where we see a lot of back wages and fines and fees that occur, because those commission dollars have to be factored into the overtime. So,
Rachel,
yeah.
I just want to clarify, our payroll system can do all this calculation for them, can it not?
It can, and not only that, I've actually written some custom grids for a lot of our clients with all the formulas in it. So if somebody has a really unique pay structure or needs something special, we can create a grid where they can just plug in hours and plug in earnings, and then it'll give us all of the correct, the effective hourly rate for the period, any overtime due. You know, we can take care of those on our end by creating a special grid. So, you know, again, being in compliance is the most important piece here, and we can do what is necessary to help get you there. Thanks, Cindy. That's a good one.
No problem.
And
I just think they do it all themselves.
You don't have to do it all yourself. And if if your brain blows up because there's too much math involved, then let me do it. I'm happy to help you with it. I love this stuff. So send it my way if you need to. So piece rate's similar. So if you have, let's say you have an electrician who is paid by the work they do. So you actually pay X number of dollars for doing task A and X number for task B and X number. And so they just get task pay throughout their pay period. Same concept. So you've got to track hours. That's the most important piece of it. And now you're going to take all of the piece rate that they earned in the pay cycle and add it together, divide it by all of the hours they worked in the pay cycle. And now you've got your effective hourly rate for that pay cycle. And then the only thing you have to do is pay that overtime differential. So all of the wages for all of the hours are paid. So if they worked over 40, or varying compliance laws in your state, then you have to pay the extra 0.5 on however many hours are overtime. So are you following me? Like, all the wages are there, and then you just pay that overtime differential for however many were OT. Good? So okay. So overtime calculations have to include extra dollars that you pay that are connected to the work. So when you pay commission dollars and bonus dollars and on-call pay and, any extra dollars that you pay to somebody that's connected to the work, you have to include that in your overtime. And I have discretionary versus non-discretionary on here because when those non-discretionary dollars are the ones that have to be included in overtime. Those are things that it's not discretionary. It is non-discretionary pay, meaning it's tied to something. So it's connected to a bonus goal. It's connected to a commission amount. It's connected to some business goal within that person's job description. So those non-discretionary dollars have to always be factored into commission or into overtime. So non-discretionary dollars, whatever they are, commissions, bonus, extra dollars, you need to make sure you include them to the overtime calculation for that pay period. Now, discretionary dollars, like everybody's doing a great job, I just felt like giving everyone a $200 bonus at the end of the quarter. Or at the end of December, we like to do a holiday bonus. That is just a discretionary bonus based on, how we're doing in the moment. So those kinds of dollars don't have to be factored into overtime. So to just kind of look back, it's still wages. It still has to be considered wages, and you pay your regular employer payroll taxes and whatnot, but it doesn't have to be factored into that overtime. Are we good?
No questions. Keep going.
Because everybody's on the floor.
They're just totally like, what is she talking about?
Or they just said, forget it. Forget it. I'm just going to call him when we get off this phone call. Okay, so let's talk about our general contractors. You know, again, we're getting this question quite a bit, especially lately. You know, should I have my employee be a W-2 or a 1099? And again, this is one of those things that has recently changed in the last 5 to 7 years, where we used to do this 20-factor test, and it was all these different categories where you would say, is it this, is it this? And that's how you determine if somebody was a 1099. And a lot of people just kind of said, well, I'm going to make everybody a 1099. I was just having a conversation with somebody not too long ago, and she said, well, I've got this client and all of their employees are 1099s. And I said, how many employees does she have? And they said 150. And I'm like, it's probably impossible for that to be the case. And what happens, what we see is you look at how much does it cost of work comp, and how much does it cost in employer taxes and Social Security and Medicare. And if I just throw them on 1099, I send them the report at the end of the year, they worry about their own taxes, nobody has to worry about it. It seems like it's a cheaper, easier way to go. It is not. It is a very dangerous risk to take, because when you have somebody who is a 1099 and should be your employee, you've got some big issues. You have potential overtime and back wage issues. You have IRS issues. You have work comp issues. So right off the bat, you've got 3 agencies who are going to come after you if they see this as an issue. And so the fines and fees alone are extremely painful. So if you think you're saving money on your work comp rate by pushing these people onto a 1099, it's probably going to backfire. Be very, very careful about doing that. And there are cases where it is absolutely correct that it's a 1099, but the way they've changed the regulations now, a lot of them should probably be your employee, your W-2. So let's dig in a little bit to what that looks like. You have 3 categories now, and they basically did the same 20 factors that they had and dumped them into one of these 3 categories: behavior, financial, and relationship. And the behavior it's really very specific. It's things like, do they wear your uniform? Do you schedule their hours and their time? Do they follow your handbook? Do you give them direct tasks and dictate how their work is done? Versus, do they wear their own uniform? Do they tell you when they are available? They follow their own set of guidelines. They let you know what tasks have been done. And so it's a very different approach to the behavior in the category. So that's the first thing you can kind of look at. The next piece is financial. How are they paid? Do you pay them weekly with your pay cycle, or do you pay them as a job is completed? Do they use your tools? Do they use your truck? Or is it the other way around? They have their own tools and supplies. They drive their own truck. And typically with a true 1099, they actually bill you. They send you a monthly invoice or bill as a vendor for the work they've completed, or at the end of the job, they bill you for what was completed on that job. So the financial piece is a big piece of that question. Finally, the relationship. Do you offer benefits or vacation? Is there any sense of permanency? Do they work for only you? Do you require that they work only for you? You know, it's an important connection. And this is a lot of times where we see if you establish any relationship or sense of permanency, then they should most likely be on your payroll as a W-2. And then within this relationship piece, you can kind of look at, we've seen this frequently too, is there may be the same job within the company where, you know, 3 individuals are independent contractors and 4 individuals are W-2s, but they're the exact same role. So that is a red flag right there, that most of the time, all of those people should be considered employees. And a true independent contractor, you can't dictate if they work for other people. They would be doing the same job for multiple clients. They are considered a vendor, and they would be working for you as a vendor. So if you need somebody to only work for you and wear your shirts and drive your trucks, they're yours. So be very careful about that and take a close look. The way the IRS looks at this is they're going to put the burden of proof on you as the business owner. They're going to presume the worker is an employee, and you're going to have to prove it. So if you have people who you pay as a 1099 contractor and that's coming into question, you're going to really have to go through these 3 points and prove that this person is an independent contractor. Are we good? Everybody still with me?
For the most part.
Okay, good. So what if you did get it wrong? First things first, fix it. You know, we've been through so many of these audits, and good faith effort goes a long way. I don't know if Claire is on the line today, but she's been through so many DOL audits, and, you know, the first thing she does is bring bagels and juice and open up clear lines of communication and show a good faith effort and really trying to make a difference. If you fix things along the way, that has a big impact. So just because you're out of compliance doesn't mean it's the end of the world, but pay attention to that. Get some help with that. We have so many experts in this field here at CertaPay. So we know you have access to all of us. And, you know, we have a lot of things we can do to help you. And when you get expert advice, you really minimize those exposure points. And if you can minimize those gaps, it saves you time, it saves you money, it saves you energy, headache, heartache, whatever it is that goes with that. But definitely pay attention to that. You know, maybe you need to have a full FLSA audit and get a complete set of job descriptions written, and then get everybody reorganized within those job descriptions. And again, we have an amazing HR team that can help you if this is something that you need, or if you want us to take a look at that. It's a place where we see a lot of financial impact when an audit is involved. And so it's okay to acknowledge that, I didn't have it right, but now I'm going to go ahead and fix it. And the other thing is, if you don't take care of these things and the DOL can show that you knew and you still did it wrong, they're a little bit more severe and harsh on the penalties. So now that all of you on this are aware and know, sorry about that. We know you know. Let's just get it cleaned up, take care of it. No big deal. We are obligated to pay our employees for all of the wages they earned. And when you have somebody who is a non-exempt hourly employee, it's very important to pay for all of those hours and pay them correctly. So finally, if you're still awake and you're still with me, just a couple things I want to say again, get help with this one. I know I just stressed that, but this is a really big deal. This is where we see a lot of financial impact just because of misclassifications. And it's important to get it right. You know, put a little bit of effort on the front side, do an FLSA audit. Let's find out if the classifications are truly correct and you're paying those wages properly, you're factoring in the overtime properly, you're factoring in commissions in compliance, whatever those pieces are. If you have 1099s, that's correct. If they're salaries, that's correct. Get it right. And finally, it's just not worth the risk. If in this particular category, having classifications that are out of compliance is so risky in terms of a financial exposure point, and it's not worth it. In the end, it will cost way more money than you think. So don't be afraid to get help on this, and let's get it right for you.
One thing I did want to mention, one of the slides Rachel referred to what was called a fact sheet. The Department of Labor has a fact sheet on just about every job description you can think of. So if you go to the Department of Labor and put in fact sheet on restaurant manager, fact sheet on banquet server, fact sheet on plumber, it will bring up all the classifications. Rachel, I don't know if you want to bring one up on your computer to show them. I just so happened to do this morning for commission sales, so I have fact sheet 20 actually up on my computer at the moment. So, but
oh yeah, that is a great point.
Labor.
Yeah, excellent point. And the DOL is also a great resource for information as well. You know, you hear all of these things and then you think, well, how do I know this is right? Well, go to the DOL. They are a great resource, and they do have a very good search engine. Just like Cindy said, you put in fact sheet on there. You could just put fact sheet DOL in your regular search engine, and it will go straight to the DOL's page and pull up these fact sheets. So you can get quite a bit of good information there. So don't be afraid to go take a look at that.
I use it all the time.
So do I. Any questions today? How we doing, guys?
Actually, we have no questions. There was one or two that I answered directly because it was just easy. But if anybody has any questions, please ask. I have no questions.
And you see this email on the screen here, hrinfo@Certipay. It actually goes to our entire HR team. And so I will see that email if you think of something later, or if you want to get some information about how we might be able to help you. Don't be afraid to send us an email at hrinfo@Certipay.com.
And don't forget, all the coffee breaks are on the website under the news tab, top right-hand corner. Just drop down and it'll say coffee breaks. And this should be up there shortly, or by tomorrow at the latest. Rachel, I do have a question.
Right.
It says, can a company using a staffing company for employees for a long period of time? I don't understand your question, Patty.
I do. I got this. Yes, Patty, you can, because you're actually paying the staffing company. So if they happen to send you the same employees all the time, there's no issue there. But those employees actually are employed at the staffing company, and you're paying the staffing company whatever your agreement is, the rate that you pay the staffing company. And then those employees belong to that staffing company. So yes, there's no limit on that. You're actually paying the staffing company for whoever they send you. So temporary employees, temporary employees are still employees. So, and again, if you have, your handbook might have some different classifications of employees. If permatemp is something you want to say, that might be one thing, but a temporary employee is still an employee. So they have to still follow all of the pay classifications and guidelines that the DOL has. So, and when somebody if you're filling a position or a role with somebody from a staffing agency, you're just using the staffing agency to fill the role.
Rachel, I see you on it during the chat box, so I'll just let you go.
Yeah. And it doesn't really matter. There's not a limit. It's not like you can say one thing or another. And when a staffing company is there, they may have limits established where you would actually bring them on board after a certain amount of time. And sometimes maybe that individual isn't available. They send you somebody else. So these kind of specifics depend on your arrangement with the staffing agency. let's see.
You want me to start reading that here? Then?
Yeah, go ahead, because I've got Colleen's. Let's see.
Colleen's is, we have an assistant superintendent and mechanics classified as exempt. I'm now thinking that is incorrect. You'd have to define the job duties of the superintendent.
Your mechanics, for sure, they are non-exempt hourly. And then your assistant superintendent, it depends on the duties. So your assistant superintendent is probably following the guidance and direction of the superintendent, right? So there's a gray area there. But if the assistant superintendents have independent thinking, they have hiring and firing, they have 2 direct reports, there's a chance they would qualify depending on their actual duties and their decision-making and independent thinking. But your mechanics, no. The mechanics would be non-exempt hourly individuals and should be keeping track of time.
Okay, the next situation, they have a chef and a sous chef. Both are salaried. The chef makes most of the decisions, but the sous chef steps in when the chef is away. Not sure how much decision-making the sous chef makes except at that time. Is that okay?
So again, we have, yeah, go ahead.
I was going to say,
no, go ahead.
My recommendation is that the chef would definitely be salaried. However, the sous chef, say that 10 times, would be an hourly position.
Yeah, most likely the sous chef will be a non-exempt hourly position, and your chef, again, needing specialized training in higher education and a higher level, and doing all of the decision making as opposed to the actual tasks. So one thing that we see is in, let's say, a retail establishment, like for example, a paint store. Let's say a small paint store where they maybe just have 2 employees in the whole store, and you've got a store manager and a store clerk. That store manager is actually doing the same duties as the clerk oftentimes, and they only have 1 direct report. So you may do things like establish them as a salaried non-exempt employee so that you are always paying a fixed salary, but you compensate them for overtime. So this is another category that we might see that's kind of a hybrid, but really meeting the salary threshold, but knowing that the tasks the individual does are not meeting the qualifications, then paying them overtime if they work over 40. And then what we see there, of course, is monitoring and managing the overtime that is allowed or what ends up being worked.
I don't remember us talking about salaried non-exempt, so I don't know if you just want to give a quick definition. Did we cover that?
Yeah, I mean, we didn't really cover it, but it's kind of just that. It's somebody who maybe they're making a large amount of money. You want to make sure they always get the same salary. And so you pay them a salary for up to 40 hours. If they work beyond that, and especially in a case where, like your sous chef, if your sous chef works overtime, you might say your sous chef is going to be a salaried non-exempt individual where he's always makes the same amount. So he's going to get that same salary, 35 hours, 38 hours, 40 hours. But if he works above 40 hours, then you will be paying the individual time and a half beyond that. So a fixed salary and then time and a half. So that is a blend between exempt and non-exempt, and it's based on duties. And so, again, it's based on decision-making.
If you have any questions, like I said, or like Rachel said, we're always here for you. The calculations can be coded into your payroll, so you don't have to do the heavy thinking on the math. And the Department of Labor is your best line of defense if you're getting ready to hire somebody for a new position that you're creating and you don't know. So that's my 2 cents.
Excellent. All right, guys, everybody have a wonderful day. That is it. We look forward to seeing you on our next coffee break in 2 weeks. Everybody have a great day.